This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
A very good afternoon, everyone, on this Monday. Did I say Wednesday, Emily Graffeo? That's
you were
how
trying
I
to
feel.
speed up the week, but it is in fact a Monday right now.
Listen, it feels like the news flow is such that we have an entire week's worth of news to get through in this hour.
That's fair. That's fair. I'm Emily Graffeo, Bloomberg cross-asset reporter, filling in for Carol Massar.
Welcome, Emily.
Today.
We are glad to have you. I want to talk a little bit about what's going on in the markets. Charlie's going to join us in just a few minutes with more details. Stocks are up, bonds bouncing from session lows. A cautious trade today. This after the Trump administration escalated its attack on the Fed, raising concerns about the independence of the central bank. We got gold and silver climbing to records. As I said, we're going to have more on the trade in just a minute, but those attacks on the Fed, a big focus for our program today.
Yeah, our global economy reporter, Enda Curran, joins us for the what, and then we're going to talk about what it means for investing in the U.S. with Michael Contopoulos, Richard Bernstein Advisors. He's going to be stopping by very soon. Also,
a big story that we've been following is everything happening with residential real estate. We're going to hear from the CEO of one of the biggest institutional buyers of single-family homes in the country. Stephen Scherr of Pretium is going to be joining us a little later this hour.
And a double dose of pharma executives we'll hear from Pfizer CEO. I did see that. Okay. That was good, Tim. Albert Bourla, just in the last hour, he said that the company will do more GLP-1 trials this year and scale AI across the business. And Owen Adams, CEO of Acadia Pharmaceuticals.
We got a packed hour right here on Bloomberg Businessweek. Stay tuned. As I mentioned, Charlie Pellet is standing by. He's got an update on the day's trade and top business stories. Hey there, Charlie.
Well, hello there, and happy Monday to you both. Lots going on. Fast-moving markets today. We came into a lot of news. Right now, the Dow, the S&P, NASDAQ, they're all higher. Certainly, central bank independence, a major theme today. Just getting word that Treasury Secretary Scott Bessent reportedly told President Trump late yesterday that the Powell probe creates, quote, a mess. That, according to reporting by Axios. The S&P right now higher by 10, very close to session highs after earlier losses. 69.76 where the S&P stands right now, up by about 0.1%. We've got the Dow up 19, up under 0.1%, while NASDAQ is higher by 91 for the NASDAQ Composite Index, a gain of 0.4%. The Bloomberg Mag 7 Index up 0.3%, with the 10-year yielding 4.17%, the 2-year 3.53%. Gold is surging $100 the ounce. Gold is at a record $46.09, up 2.2%. Silver, big story there, $85.48 right now, up 7%. West Texas Intermediate crude, we'll call that unchanged on the day, $59.13 for a barrel of WTI. And Bitcoin up 0.8%, 91,363 on Bitcoin. Let's talk credit cards. JPMorgan Chase, Capital One Financial, and shares of other American banks all lower after President Trump called on credit card companies to cap rates at 10% for a year. Among those bank names, JPMorgan Chase ahead of earnings tomorrow, down 2.1%. Capital One Financial hard hit, down 6.5%. Among some of the charge card companies, Visa down 1.4%, MasterCard down 1.6%, and American Express down by 4.3%. Again, recapping, the Dow, the S&P, NASDAQ moving higher. S&P right now up 9, gain there of 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Do appreciate it. Well, as I mentioned, the top story that we're following this afternoon is President Trump and the Department of Justice and the Federal Reserve. The president actually facing some rare opposition from key Republican lawmakers after Fed Chair Jay Powell accused the DOJ of a pressure campaign. This after the Department of Justice subpoenaed the Fed. Senator Tom Tillis, a key Republican on the Banking Committee, reminder, he's not running for re-election. He vowed quickly last night to oppose any Trump nominees to the Fed until this matter is resolved. Freddie and Fannie Director Bill Pulte, a driving force behind the Trump administration's decision to subpoena the Federal Reserve, I should say FHFA Director Bill Pulte. This according to people familiar with the matter. Here he is on surveillance responding to that accusation.
The DOJ is outside of my purview. This is out of my purview. I don't know anything about it, and I would defer you to the DOJ. My main focus, John, has been on reducing mortgage rates to the extent that we can do it and increasing housing affordability.
That's FHFA Director Bill Pulte on surveillance a little earlier today. I want to bring in Enda Curran. He's Bloomberg News global economy reporter. He joins us from our Washington, D.C. bureau. Enda, does Fed Chair Jay Powell have anything to be concerned about? Does he have cause for legal concern here?
Oh, it's definitely pushing the tensions through the White House and Fed to a next level, no doubt about it. You know, as you well know, it's unprecedented, potentially, on paper at least, suggesting potential criminal charges against Federal Reserve economic policymakers, if not the chair himself. So lots of unknowns about all of this. At the very least, it does speak to the idea, and this is what a lot of Fed watchers today are saying, speaks to the idea that, you know, President Trump really is deadly serious now about casting his imprint, remolding the Fed in his worldview as much as possible, and that involves piling pressure on Chair Powell to leave the Fed when his term of chair is up in May, because one of the subplots of all of this is that while his term as chair is up in May, Mr. Powell can remain on the board until early 2028. And the thinking is if he stays on the board, then he might remain, you know, continue to defend the Fed's independence against the White House and push back. And obviously that doesn't suit the White House agenda. So that's why people are saying there's this pressure being put on him right here, right now. But it's unprecedented, a lot of unknowns around how this plays out. And certainly it sets up a very protracted few months ahead.
What kind of response do you expect from Congress or the Treasury in terms of making an official response here?
Well, we've had a very interesting intervention, as you mentioned a moment ago, from Senator Tillis. His is especially interesting because he's on the committee responsible for confirming the next Fed chair. That committee is very finely balanced, 13-11. He's come out and said that, look, I'm not going to vote for anyone until this legal issue is sorted out. And that suggests that no matter who the Trump administration nominates to be Fed chair over the coming weeks and months, as long as this legal issue plays out, well, then they're going to struggle to get it through the Senate committee for approval. And then you're in a scenario, if you step back from that, you kind of go, hang on the one hand, you've got the Fed locked in this legal battle with the administration, question marks over current chair Jerome Powell's future. And on the other side, on a parallel track, it's going to be possible that a Fed chair may not be confirmed, a new Fed chair may not be confirmed, or at the very least it'll be a very protracted and ugly process running alongside in tandem. So this is where things start to get very complicated and very uncertain in terms of how all of this plays out.
Why are we seeing more of a market reaction? And if indeed the Fed's independence is being threatened right now, why aren't we seeing markets react?
Tough to say. I mean, markets really have been brushing off a lot of major world events, of course, in recent times as well. But, you know, a benign take is that this is such an escalation that some people out there believe there has to be an off-ramp. You know, there's a view out there that this was kind of uncoordinated from the administration. President Trump himself said he didn't know about it to NBC last night, and maybe they look for kind of a way to de-escalate it. But there are plenty of those who tell you that's not really going to be the scenario, because President Trump, again, has previously warned he was considering a lawsuit against Chair Powell. We know he's deadly serious about his pressure on the Fed, and that side of things kind of tell you this could be more of a slow burn market effect. Not a big bang, gee whiz, oh look, pressure on the Fed, but over time they start to lose confidence, start to see that independence being corroded, and then by extension that goes into portfolio decisions, and you start to see it in securities prices. So I think the slower burn, longer term play out is the kind of camp that's, I think, winning that debate at the moment.
Well, there was a note from Wells Fargo earlier this morning saying markets are on alert but seem to be waiting for kind of like what you said, tangible action. And the analyst noted that the Supreme Court ruling that the Trump admin can fire Lisa Cook would qualify as that tangible action. I'm wondering if we can learn anything from just the events that have unfolded today about how the Supreme Court is going to rule on Cook.
Yeah, tricky to say. Again, a lot of tempting parallels between both, but we don't yet know. I mean, those hearings haven't even been heard yet. We don't know what kind of stance the Supreme Court will take on the Governor Lisa Cook case. And even if they do issue a ruling, let's just say broadly favourable towards Ms. Cook and the Fed, well, a lot of questions will be around, well, what kind of ruling what are the details of that ruling? I mean, is it a near-term reprieve, and does it set it up for the White House to come back for another swing by following a kind of a roadmap that the Supreme Court sets up? Or does the Supreme Court really knock that whole idea out of the park altogether, in which case, to your point, you know, it would be seen as a resounding victory for Fed autonomy from this kind of interference. But We don't know, but what we do know is that we have now a situation where the Fed is at the whim of the courts in a way it hasn't been before. You've got the Lisa Cook case, you have potential for criminal charges against maybe Chair Powell, others at the Fed over the building renovation. No one knows how this is going to play out, other than it certainly has a long way to go and will likely have many more unexpected twists before it does conclude.
And I think it also makes the next Fed chair's job incredibly challenging. A front runner certainly has been, as widely reported, has been Kevin Hassett. The president has said that he has made up his mind. He told the New York Times that last week. But what are the challenges that the next Fed chair faces apart from the dual mandate, stable prices and maximum employment?
Yes, I mean, it's kind of getting to a point where the economy feels almost secondary to this legal and political debate that's surrounding the Fed. But let's just say the next Fed chair does get confirmed. It looks like it'll be an awkward process now, but let's just say they get confirmed at some point over the months ahead. Well, whoever that is, when he or she comes into the office, really will have to double down and prove to fellow Fed policymakers and the investor community and the rest of course, the economy, that their number one interests are putting the economy first, that they're dedicated to serving the Fed and the people and the broader economy. Now, whoever comes in as an appointee of Trump was always going to have to work hard to prove that they're not just beholden to the Trump White House, that they're not just beholden to politics. That was always going to be a challenge. But whoever does come in now after this latest development is really going to have to double down and work hard to gain that trust and confidence from markets, or they will be literally an agent of the White House and will be seen to be doing the White House bidding. So I think in terms of optics of all of this, that will be a challenge for whoever takes over.
Enda Curran, Bloomberg News global economy reporter, joining us from Washington, D.C. I want to stay on this story and continue with this unprecedented move by the Trump administration. For more, we're joined by Michael Contopoulos, Deputy Chief Investment Officer at Richard Bernstein Advisors. The firm has more than $17 billion in AUM. Michael joins us here in the Bloomberg Businessweek studio. Good to have you on the program. You were arguing that there was like a move away from U.S. exceptionalism even before we got this news last night. Does this just mark for you that this is the end of U.S. exceptionalism?
Well, I think we are definitely in a transition period. It's hard to say whether or not we're, marking the end, or it's just sort of a different phase of U.S. exceptionalism. But listen, I think a lot of things as I look out, not only over the next 1 to 6 months, but when I look out over the next 1 to 6 years, I think there are a lot of signs pointing towards a lot of opportunities throughout the rest of the world. You're transitioning from a world of quantitative easing and zero interest rate policy and the creation of so much capital and liquidity that drove U.S. excess. You're seeing a big transition, I think, away from that. And I think that's going to be a story that we see for quite some time going forward.
Why don't you think the bond vigilantes, the so-called bond vigilantes, have come out in full force today?
Well, I think there's still some hope here that the market is going to be able to absorb a lot of this volatility and ultimately be the final say on Fed independence and things of that nature. I'm of the opinion that markets are ultimately going to decide where rates are, not the Fed. And because of that, a lot of this noise around, say, Chair Powell today and around some of the recent announcements by President Trump is really a sideshow. And so I think markets can read through a lot of this noise and navigate the noise pretty efficiently.
Does the end of U.S. exceptionalism mean sell America? Are you looking for 2026 to be the year that you actually sell your U.S. equities?
Well, obviously, U.S. equities last year did quite well. International equities, even did better. In many parts of the world, you've seen that. I think it's more about rotation than it is necessarily sell U.S. The problem is that much of the U.S. equity market is dominated by such a small handful of companies. You could have, underperforming or weak U.S. equity markets and strong international markets without the rest of the U.S. market necessarily doing poorly. So it's not necessarily that. I think this is a big wholesale sell America trade in 2026, but I think rather a rotation to other areas throughout the world and away from excess and liquidity-driven bubbles.
One more on the Fed, because Axios is reporting that Scott Bessent, the Treasury Secretary, told the president late yesterday that the Fed investigation, or that the federal investigation into the Federal Reserve Chair, quote, made a mess and could be bad for financial markets. Is there a way to come back from this? Is there something that the president could say? Is there something the Department of Justice could say that says, wait a second, actually, we're pulling the reins in a little bit.
Yeah, I mean, I think we've all seen the taco trade before, and when the heat gets, obviously a little bit too high, President Trump is more than willing to back away from, policies or statements or rhetoric, and I don't see why this would be any different. And so if you saw, say, for example, say you saw the 10-year back up towards 5%. Or if you saw equity markets start to tank, I think absolutely you would magically see this go away, and a lot of quiet around Chair Powell.
If the bond market got yippy,
if the bond market got yippy, which
like
yes,
the president said in April.
Correct.
Okay.
Yeah, I think that's right.
We can't let you go without asking you about credit markets because you did start your career as a bond guy, even though now you're have a broader mandate here. But last week we had global bond sales. It was one of the busiest weeks on record.
Yeah.
Are you buying?
No. I actually did a shout out to James Crombie and did a podcast with him last week as well to talk a little bit about this. And, we are not buying credit markets at the moment. I think they're incredibly richly valued. Some of the richest I've ever seen in my career. There's just very little upside. Why own corporate credit risk? Why own the uncertainty around coupon, ultimate payment, and principal when you can own agency mortgages, when you can own munis, and when you can even own short-dated treasuries and shorter term debt out there with a fraction of the risk and similar, if not better, upside. So no, we're not buying corporate credit here. We're comfortable actually holding zero and waiting for much better entry points, hopefully this year. And if not this year, we'll just wait until there are some.
The everything bubble that you look out and you see, oftentimes we talk about a so-called bubble in AI, but you say there's a bubble out there everywhere. What do you see and how do you stay safe?
Yeah, well, first of all, I think much of the bubble is actually starting to deflate. And that's really helpful to see. I mean, since October 31st, meme stocks, SPACs, crypto, Mag 7, they've all meaningfully underperformed. So now we're talking in 2.5 months of underperformance. I think this is going to continue in 2026. The opportunities are plentiful, though. I think almost everything other than the Mag 7 within the United States offers a great opportunity. I think agency mortgages and credit or fixed income markets offer a great opportunity. I think international developed offers a great opportunity. When you look at Europe, when you look at Japan, you have much more reasonable valuations with really strong earnings growth and strong dividends. And that's a great total return picture with less volatility and better valuations than the United States at the moment.
Just in the last couple seconds here before we let you go, if you had to look at the kind of cross-asset trade today and point to a sign that investors are nervous about Fed independence, what would you point to? Because I'm looking at equities right now, and we are trading higher today.
Yeah, we are trading higher. Rates aren't moving very much. I think it's telling you exactly what it's telling you. The market's not that worried about, rhetoric. I think we've become a little bit, as market participants, desensitized to the daily news flow. Maybe that's a good thing, and maybe it'll come back to bite markets. I think looking at rate volatility, looking at funding markets, looking at all the sort of normal areas of stress are the right ones to look at. Right now, it'll tell you that we don't have, or the markets don't have anything to worry about, and this is really just noise for the time being.
Michael Contopoulos, Deputy Chief Investment Officer of Richard Bernstein Advisors, joining us here in the Bloomberg Businessweek studio. Thanks so much.
Thank you.
Have a good week. Hey, just taking a look at what's going on in the S&P 500 right now. It is higher by 0.2%. Financials, though, underperforming, perhaps unsurprisingly, given another thing that President Trump said late last week. We're going to be talking about that during our 3 o'clock hour. In the meantime, coming up next on Bloomberg Businessweek Daily, the CEO of Pfizer, Albert Bourla. That's next on Bloomberg Businessweek Daily.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at records right now for both the Dow Jones Industrial Average and the S&P 500 Index. Any advance today will be another record. The S&P right now up 13, up by about 0.2%. The S&P currently at 69.79. Stocks, bonds, and the dollar all bouncing from session lows. Caution, however, is prevailing after the Trump administration escalated its attack on the Federal Reserve, raising raising concern about central bank independence. The Dow up 13, little changed. Again, the S&P up 0.2%, keeping it all in context. NASDAQ up by about 0.5%. 10-year at 4.17%, with the 2-year 3.53%. Gold is up $103 the ounce to $46.13, up 2.3%. West Texas Intermediate crude $59.40 a barrel, up 0.5%. A move for Bitcoin up 1.2%, 91,703 on Bitcoin. Paramount Skydance is ratcheting up the stakes in its months-long battle for Warner Brothers Discovery, saying it plans to nominate directors to the board to thwart a merger with Netflix. Paramount Skydance up now by 0.6%. Shares of Warner Brothers Discovery down 1.6%. Netflix up 0.1%. Recapping, stocks are higher. S&P at a record for on-demand news 24 hours a day. Subscribe to Bloomberg News now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. A huge week for anyone in healthcare or anyone who follows healthcare. It's the 44th annual JPMorgan Healthcare Conference. It's underway in San Francisco. This is the largest investment symposium in the industry. It's got everyone, pharmaceutical leaders, biotech innovators, investors, policymakers. They're all there. So is Katie Greifeld. She's the co-host of The Close. She's standing by right now with Pfizer CEO Albert Bourla. Katie, take it away.
Thank you, Tim. You're right. Sitting beside me is Albert Bourla. He is the CEO of Pfizer. Dr. Bourla, it's great to see you.
Great to see you. Thank you. Happy New Year.
So let's start broad here, because when the average person or uninitiated investor thinks of Pfizer, they probably think about your COVID vaccine. And now in 2026, the COVID period is largely behind us. You have numerous patent expirations coming up, and Pfizer is also entering into new markets altogether. So when you add it all together, what is the next era for Pfizer?
I think we were preparing for this period of loss of exclusivities, 26, 28. We did significant acquisitions. One of them is in obesity, as you said, but Seagen in oncology and Nurtec in migraine. And this portfolio is performing extremely well. This year will be approximately $10 billion of sales, growing double digit. Actually, last year, 25. And 26 will continue growing at double digit. So I think after the 28 period of LOEs, where we are not going to be a top-line growth story, we will have exponential growth that will be leading the industry.
So 28, it sounds like things improve, especially when you think about the growth forecast there. But until that time, you think about what you recently said at the fireside chat earlier today, no plans for buybacks. You do have these patent expirations coming up, and you don't expect to put a GLP-1 on the market until 2028. So how do you keep investors engaged and attract new investors during that period?
I think investors want to see catalysts, and this is a year that is very rich in catalysts. We are expecting readouts of studies that they are significant. Two of them actually will be in obesity with Metsera portfolio. One, it is the ultra-long 30 days data, so the monthly dosing data that will come in the first half of this year. The other is the combination of GLP-1 and amylin that also will come this year. But there are many more. Elrexfio, which is our myeloma drug, has a readout that, if successful, doubles the population that we are going after. The vaccine against the tick, thank you, which is a very big disease that there is no vaccines so far, and that's the first one, Lyme disease. So there are very rich in catalysts. And of course, we start a lot of phase 3 studies. So investors, I think, are watching all of that. And right now, Pfizer has a very low multiple. I think we should start migrating towards the average multiple and then exceed it as we go post our LOE.
So plenty of catalysts coming up. Let's talk specifically about Metsera, because you won that hard-fought bidding war with Novo Nordisk. Certainly fun for someone who consumes news to watch. When you think about the obesity market, though, you mentioned that this would be once monthly. What do you see as the key differentiating factor when it comes to what Metsera is developing?
I think one, it is the monthly dosing. That's a very clear differentiation that creates significant advantages, not only in patient experience, but also in production and cost of goods and all of that. The second is the combination between amylin and PD-L1. We are looking for superior results than the current solution. So this combination not only will be a monthly, but hopefully can deliver better weight loss, placebo adjusted, and better tolerability, which are the two things that are the Achilles heels of the GLP-1s right now. And of course there is an oral portfolio of peptides that is following. So it's a very complete, highly differentiated portfolio in the hands of a company that it is very good in commercial activities, particularly when it comes to products that they are very much consumer driven. I remind you, Viagra was a product that was behaving very similarly like the like the GLP-1s.
Well, looking forward to those readouts as we get deeper into 2026. I do want to talk about M&A overall and what the strategy going forward is, because last year you earmarked up to $15 billion for deals to help replenish the pipeline. Where are you now? Do you feel pretty satisfied with the portfolio at hand, or are you still looking for more deals?
I'm very satisfied with the portfolio in hand, and we invested almost 10 of these 15 billions, and then we have 5 to 6 that are remaining, and we plan to invest them. We don't have to invest them, but we're trying to make sure that we will find the right assets, as we found with our oncology and obesity acquisitions.
And when it comes to cost cutting, last month you said that you're going to reinvest about $500 million from savings from your cost cutting efforts into R&D. And I'm curious, where do you see that investment going? Should we be focusing on the obesity portfolio, or are there other areas of Pfizer where you plan to fund that?
Let's start that the oncology portfolio right now absorbs approximately 40% of our investments, and that will continue going up. But the newcomers are the obesity, that, as I said, we start with more than 15 studies. 10 of them will be pivotal phase 3 studies. This is a significant investment, but also demonstrates how confident we are in investing in these molecules.
And I do want to talk a little bit about the political landscape as well, because you were the first drug maker to strike a pricing deal with President Trump last year. And I know that this is pretty much an impossible question, but do you feel like you're out of the woods when it comes to surprising tariff threats, price cuts, etc.? What have your conversations with the White House indicated so far?
As you said, it's a very difficult question, but and because of the uncertainty that we know exists always. But we have created very solid agreements, and we have created a political environment that there is good willingness from the White House to respect and actually to help us with pricing outside the U.S. They're helping us a lot, actually, with pricing outside the U.S., with UK being the most visible example. I think Secretary Latnik achieved a lot there. In UK, they made changes in their system that will invest way more in innovative medicines than before. So I'm optimistic that it's behind us.
And I am curious, you think about how long you've been at the helm of Pfizer. When you compare and contrast just the frequency of communications that you're having with the Trump administration, how does that compare to past presidents at this point?
Look, I was very close with the Trump administration in the beginning. I was very close with the Biden administration because we had to work together with COVID.
That's right.
With Trump, we worked together to develop the vaccine. It was all his baby, right? The Operation Warp Speed. But with Biden was the period to scale it up, to invest it. I would say that we were always very close to the Congress and to the White House. I spend a lot of time in Washington myself, a lot.
And given that you do spend so much time in Washington, and again, given that you were the first drug maker to sign on to, these drug pricing deals, what takeaways, would you give to other CEOs who are currently in conversation with the White House?
I think engage and discuss. I think I'm very proud of what we did. I think what we did opens the way for the entire industry. Probably already 17 companies now have signed up, and it is the same model like we opened, and puts to bed an issue that was not sustainable. The big difference in pricing between US and other rich nations, and now that it is probably resolved in a gradual way because it's all the new products. So it's a good deal, and the others should engage and do the same.
All right, Albert, I have about 10 more questions for you, but unfortunately, we're up against the clock. So appreciate your time.
Thank you very, very much.
That is Albert Bourla. He is the CEO of Pfizer. Back to you, New York.
Hey, Katie, thanks so much for that. That's Katie Greifeld of Bloomberg TV's The Close out there with Pfizer CEO Dr. Albert Bourla. And we apologize for some of the audio issues. We're going to work on clearing that mic up and heading back to San Francisco for the JPMorgan Healthcare Conference a little bit later in the program. But Emily, what we did hear from Pfizer CEO, they're looking for, quote, superior results on weight loss drugs. The company also said that they're, quote, very satisfied with the existing portfolio, and the new GLP-1 studies are major investment and are showing confidence. Just some of the headlines that we're seeing out of the JPMorgan Healthcare Conference.
Yeah, it's been really interesting to watch how pretty much every single healthcare company out there is looking to get in on the GLP-1 or weight loss drug trend. Pfizer specifically is a name that it seems like everyone on Wall Street knows, but also the consumer knows it as well. As Katie Greifeld was talking about, the company is now known, it feels like in pop culture, for the COVID vaccine. So now the question is, how can they pivot away from that?
And that's been to the detriment over the last few years, as you've seen companies like Eli Lilly, companies like Novo Nordisk just surge past them in terms of interest with GLP-1s. Pfizer essentially went all in on the COVID vaccine. Mm-hmm. We saw what happened at the beginning of COVID, and it was a huge boon for the company. But look at what's happened to Moderna since then, and the challenges that Pfizer has had since then too. So yes, like you said, it's all about that pipeline.
And I'm looking at the shares right now. So shares of Pfizer, year to date, they are higher, but it's the beginning of the year. So down about 5% on a price change basis from about 12 months ago for Pfizer. It's been significantly underperforming the S&P 500.
Hey, we're going to be back at the JPMorgan Chase Healthcare Conference in just a few minutes. Catherine Owen Adams is going to be joining us. She's the CEO of Acadia Pharmaceuticals. We're going to hear from her in just a few minutes. In the meantime, I do want to take a look at what markets are doing on this Monday afternoon. We're seeing the S&P 500 march higher, up 0.2%. The NASDAQ Composite higher by about 0.5 percentage point. The Dow higher by about 0.1%. In the S&P 500, every single industry group in there is actually in the green today. Consumer staples leading the pack up 1.5%. Information technology up 0.8%. Materials up 0.6%. Financials, though, Emily, down about 1%.
On that credit card news, of course, it's hard to argue today that it's a sell America trade. I mean, we started this morning, we were in the red, but markets have rebounded from that.
I should have shrugged it off.
Yeah, I would argue the record moves in gold, perhaps showing a little bit of investors looking for a hedge and looking for safety.
That's a good point. Hey, coming up next, like I said, we're sticking out there in San Francisco, the CEO of Acadia Pharmaceuticals. That's next on Bloomberg Businessweek Daily.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Wall Street staging a cautious bounce right now. This after the Trump administration earlier escalated its attack on the Fed, raising concern about central bank independence. But right now, the Dow, the S&P, NASDAQ 100 index, and yes, the Russell 2000 index of small cap shares all moving higher. S&P close to the best level of the session right now, up 14 at a record 69.81. Closing in on 7,000. We're looking at a gain now of 0.2%. Any advance today for both the Dow and the S&P will be a record. Dow Industrials up 20, little changed, up under 0.1%. NASDAQ up 122 for NASDAQ, a gain now of 0.5%. The NASDAQ 100 index up 0.3%, with the Russell 2000 index of small cap shares up by 0.3. The 10-year at 4.18%, with the 2-year that's currently yielding 3.54%. Spot gold up $107 the ounce to $46.16, up 2.4%. And West Texas Intermediate crude up 1%, $59.71 for a barrel of WTI. President Trump says he is leaning toward excluding ExxonMobil from his push for U.S. oil majors to rebuild Venezuela's petroleum industry, citing displeasure with the company's response to his initiative. Again, recapping, stocks higher, S&P up 0.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Well, thank you, Charlie. And shifting policy, affordability pressures, and innovation in therapeutics are just some of the key themes shaping the global healthcare industry right now. One publicly traded company emerging as a key player in the space is $4.5 billion Acadia Pharmaceuticals, which specializes in neuroscience and rare disease and has the first and only FDA-approved treatments for Parkinson's disease psychosis and Rett syndrome. We're going back right now to the JPMorgan Healthcare Conference in San Francisco to speak with Owen Adams, CEO of Acadia Pharmaceuticals. Catherine, thanks for joining us. Let's start by talking about kind of investing in neuroscience and rare disease. What makes this category an investable one?
Yeah, great. Thanks for having me. I'm really delighted to be with you here today. What makes neuroscience and rare investable? I think primarily it's the huge unmet medical need that still remains for these populations. As we know in neuroscience, it's a big load of disease areas: Alzheimer's, Lewy body disease, dementia, all huge unmet areas of unmet need. And rare disease, I think it goes without saying, 95% of rare diseases don't have any therapies associated with them. And so for us, putting those two things together, it's a great place to be in terms of bringing innovation to patients.
Catherine, one thing that we're trying to understand is the effect of some of the cuts that the U.S. government has made when it comes to research at universities across the United States. Oftentimes, the research takes years to actually then go into some sort of medication or treatment. That then has to get approved by the FDA, and then that has to get to patients. It's a very, very long process. Any investors in biotech are very familiar with this. Has the pipeline been disrupted, though, because of cutting off of funding by the U.S. government?
You know, from an Acadia perspective, it has not. We continue to work with partners who are in preclinical and clinical stages, as well as our own internal groups. But what I have heard from some of our earlier stage discussions is that those NIH cuts are being felt. And I do worry longer term that knock-on effect will be felt, especially by smaller biotechs who rely on academia for a lot of our initial innovation. So I think for now, no, but longer term, I do definitely worry about that.
When you think about the recent policy changes in Washington, does it affect at all what drugs or treatments that Acadia pursues going forward?
I mean, I think the short answer is no. We have a strong focus on neurological and rare disease. We continue to believe that's the right place for us to focus. Our focus is on the patients and those communities where they don't have options. And the changes in the administration, they come and go and we deal with them. But ultimately, our focus is on that patient need.
Do you have a line to Washington, D.C.? Do you have communication with either the secretary of Health and Human Services or the FDA chief? Do you have that line of communication?
You know, as a CEO in biotech, I think it's important to be out there developing those lines of communication, which is why I've been so involved in bio. I'm on their executive committee and I lead their emerging companies section with a fellow CEO. I'm also part of the mid-size Biotech Group of America, and both of those groups are having active discussions with all types of policymakers, whether it's on the Hill or at the FDA. We're actively engaging to ensure that they hear our voice when some of these policies move from, voluntary to actual legislation. It's important that those voices are heard as that legislation is being drawn up, and I'm actively out there making my voice heard.
What is your voice saying right now? What are you telling them? What are you telling the group? What are you saying as a group? What do they need to hear?
Yeah, I think what we're trying to encourage thought around is that we appreciate that there needs to be changes in how we are innovating globally around healthcare, and costs are pressuring all governments around the world, but that small biotech is the lifeblood of future innovation for patients. And the policies and legislation that they're trying to apply to large pharma businesses, where I've been for the last 30 years and appreciate that there are many more trade-offs that those large pharma companies can make. As a small biotech, our opportunity to trade off is very limited. And so we're making sure that they're hearing our voice around ensuring that there are appropriate carve-outs, maybe for rare disease or smaller biotech, so that the legislation isn't a peanut butter approach, but it's really thought through. I don't think anybody's out there to try and shut down innovation in biotech, but sometimes these things have knock-on effects that aren't thought through initially. And so we're really trying to get our voices heard so that that can be taken into account as the legislation is developed.
Talk to us a little bit about affordability, because some of these rare diseases, and like we said in the beginning, you have the first and only FDA-approved treatments for Parkinson's disease psychosis and Rett syndrome. How do you think about affordability for rare disease therapies? Is it more expensive for the patient than something else?
You know, we really try and work hard to ensure that it's not. We have a strong focus on patient support and patient support services, and not only financially, but also people that they can call on to help them through the various stages of insurance, and whether those processes are going smoothly after they start therapy, whether they've got people to call to ensure that they are understanding maybe side effects that they didn't know about. So we really do a lot to ensure that our patient services are thorough, especially in the rare disease space. And we work a lot with the patient advocacy organizations. Their voice is so important in our rare disease community. We have a big team who's out there getting those voices into our commercial teams, into our R&D teams. And that's how we've developed our new formulation for DAYBUE. We heard from our community that they needed something different, and we got that approved in December. So that two-way communication is huge in terms of rare disease.
Catherine Owen Adams, thanks for joining us this afternoon. Appreciate it. Catherine, CEO of Acadia Pharmaceuticals. Healthcare certainly in focus as the JPMorgan Healthcare Conference is underway in San Francisco. Also, what we're watching closely, what's happening in the housing industry. This after President Trump last week brought the issue of corporate home buying front and center when he pledged in a social media post to stop institutional investors from buying more homes. Some major owners of single-family rental homes were blindsided by the news, this according to people with knowledge of the matter. And we saw shares of institutional buyers dive on that. One of those major owners of single-family homes joins us now. Stephen Scherr is co-president of Pretium. The firm has more than $60 billion in assets under management, including around $32 billion of real estate. It owns and manages more than 82,000 homes in more than 30 markets. Also joining us, Sridhar Natarajan, Bloomberg News chief Wall Street correspondent. They both join us here in the Bloomberg Businessweek studio. Welcome, guys. Thanks for joining us. That's where I want to start, Stephen. Sure. The edict from President Trump, did it blindside you? Did it come as a surprise?
Yeah, we did not expect nor anticipate that would be kind of an initiative that the president was going to take up, specifically as it relates to single-family homes. Having said that, the president is putting and has put on the table a critically important issue for the country, which is affordability of housing. And I think in as much as we were surprised by his social media post, we stand quite ready to be a force for a solution where private capital can play a very active role in the housing issue. Affordability in and of itself is very much a supply-demand equation. The country is short anywhere from 3 to 4 million homes. It's more acute on the rental side than on the ownership side. So surprised in the news, not surprised, in fact, welcoming of the issue being put on the table and quite ready to be a part of that solution.
Right, affordability, not coming to anyone as a surprise who's been following the housing industry for the last, 4 or 5 years at this point. I think everybody's familiar with the idea of supply and demand being the issue. But I guess I'm curious about what specifically you can do and what private capital can do to be part of the solution.
Sure. Well, for one, there have been a lot of fits and starts around rent-to-own propositions. That is, where somebody rents a home and migrates toward a place where they can own it. We play a role right now in that people that rent homes with us and others in the industry improve their credit standing, and it is a pathway to get there. Now, private capital can play a more assertive or more aggressive role in that process. Imagine a scenario in which rent is paid, money's held back to provide against a deposit account for a down payment on that home. That person may have access to that to bring the down payment down. Imagine mortgages in the 1 or 2% category where both banks and the GSEs could play a role. Imagine where we were to link arms with home builders who could build smaller, more affordable homes that could be affordable. At the moment, if you look at just the homes that Pretium rents, 90% of our renters are not eligible for a mortgage. So you start there with a big issue that's in play. In the affordability question more generally, just know that on a like-for-like basis, to own a home relative to rent a home is about 40% more expensive. Mortgage rates are implicated by that, property taxes, insurance. So this is a larger issue, but one where, again, if we were to come up with a method by which a rent-to-own, a credible rent-to-own project could be put in place, I think private capital could be a key participant in that.
You talk about linking arms with other stakeholders. Home builders are obviously another important part of this conversation, and administration has had conversation with a lot of leaders there. What specifically can you do when you do link arms with, say, home builders or some of the other stakeholders? What proposals could you put forward if, of course, the idea of a complete institutional investor ban is unacceptable, which is to you?
Sure. Well, I think any solution to this, which is to migrate more and more people into a place where they can afford a home, is going to involve a lot of different parties. Private capital being one, the home builders being another, banks and the GSEs around mortgage reform being yet another. And obviously the administration has taken some steps now in terms of repurchases of mortgages to sort of bring that more in line. So it's going to take a lot to sort of pull that together. I'm quite confident, though, that private capital can play a role in it. By the way, that would not be new to this administration. Remember, in the first Trump administration, Opportunity Zones was signed into law in 2017. That was basically to take capital, private capital, that was being harvested from one investment and put it to work in an opportunity zone, an area or a zone that had or was in need of capital. That was a very solid proposal and program. About $100 billion of private capital was put to work. By the way, it was made permanent in the second Trump administration. So there's a basis by which private capital can be harnessed and put to work. I think this is an extension of that. And I think if the administration were to sit down with a group of us, we could put a proposal, we could put a project together.
And after the Truth Social bombshell, are we still in shock, or have some of these conversations started to take place behind the scenes, at least within this group?
Sure. Conversations, as you might imagine, have begun among industry participants, among the home builders and those that are representative or stewards of capital in the single-family rental. Those conversations will prove constructive. In as much as any and all of us were surprised by the announcement, the issue of affordability is not news to us, and we have made inroads previously to try to improve the ability of people that rent homes from us to ultimately migrate toward a place where they can own a home, credit improvement and the like.
We're speaking with Stephen Scherr, the co-president of Pretium, more than $60 billion in assets under management, among the largest institutional owners of single-family homes in the country.
I'm curious what the investment implications would be if we did see a ban. Where would the institutional capital go if you weren't able to invest in single-family homes?
Well, I think it's important to note, Secretary Bessent noted that there's no intention here to compel sales. So there are large portfolios of homes that are still out there. There's also a multifamily business. If you just look at the business of Pretium, we are both on the equity and the credit side. We extend billions of dollars of credit that's given to us and invested with us that we extend out to smaller and mid-size home builders and developers. We have a mortgage business, we have a multifamily business. So there are various aspects of our business that would not be implicated even by the proposal that's been put on the table. But as I said, I don't view an outright ban as being the logical end state. I think there's an opportunity for a big, beautiful housing bill to come together, to which we would play a part. And then equally, as I've spoken about, the opportunity for private capital to play a very specific role in improving the ability of people to rent.
Still, the criticism of institutional investors of single-family homes, it doesn't come as a surprise to you. Bill Pulte, FHFA, was on earlier today on Surveillance. He said, "I was on board of Pulte Home for 4 years. I understand what institutional buying does. It's very powerful." Senator Elizabeth Warren has said that, quote, "Congress should work on legislation to stop corporate investors from buying up homes. How would you respond to them specifically?
Well, they are right. I mean, the amount of capital that private capital brings to the table is important, but it's important to understand how. So, for example, large home builders are taking on projects all the time. If they have a project of 100 homes and private capital in the rental category are speaking for 25% or a third, those homes will get rented. That means that the other 2/3 to 3/4 are being sold to individuals that want to own a home. It just means that the project that home builders are taking on is de-risked by the proposition that private capital is there. I'd also say, as to Director Pulte's comments, it's important to note there's been a time migration as to how homes are bought in and among this industry, okay? It began more than a decade ago as single-family purchases on the MLS listing. These were largely homes that were in need of considerable capital, and companies like ours and others put $30,000 a home in to improve the housing stock. That has migrated now to where single-family or single purchases on the MLS are a de minimis component of what's bought. So the notion that we are now, perhaps as in the past, somehow boxing out individuals from owning a home, I just think is no longer right. It's no longer a contemporary observation of what's playing out.
You know, you make a point that this proposal is likely not to play out in its most extreme form. But for a second, can you sketch out the worst case scenario for the American public if something like this were to go into effect, if institutional investors were completely banned from buying homes, single-family rentals?
Well, I think if private capital was sidelined, that would only serve to worsen the problem, not make it better. This is an enormous industry. So there are 145 million households in this country. About a third of them are rental. And by the way, it's been a third for a long time. So that hasn't changed. And the place of private capital to sustain that, to try to address the supply-demand imbalance, is an important component. So the reality is, if private capital is pulled away, this would have negative, not positive effect on the ultimate solution to create an affordable stock of housing, which, as I said earlier, is more acute on the rental side than it is on the home ownership side.
Stephen Scherr, co-president of Pretium. Also, Natarajan, chief Wall Street correspondent, both joining us here in the Bloomberg studio. Coming up on TV, it's The Close. Next on radio, Bloomberg Businessweek Daily.